Bollinger Bands are one of the most popular technical analysis tools implemented in today's trading environment. So here, I'm gonna teach you this amazing indicator, and you will just need to spend 10 minutes to watch this video to the end. Then you could just master it professionally. Hi, I'm Alice. If you like my video, welcome to subscribe my channel. As the name implies, Bollinger Bands refer to the bands or price channels placed on the chart to represent a volatility range. Bollinger Bands consist of a set of 3 bands drawn in relation to price. There is the 20-period moving average in the middle, with an upper and lower band of 2 standard deviations above and below the simple moving average. Bollinger Bands use a statistical measure known as the standard deviation to establish where a band of support or resistance levels may lie. This concept is also known as a volatility channel. A volatility channel plots lines above and below a center measure of price. These lines, also known as the envelope or bands, widen or contract according to how volatile or non-volatile a market is. Bollinger Bands measure market volatility and provide lots of useful information, including trend continuation or reversal, periods of market consolidation, periods of upcoming large volatility, breakouts, possible market tops or bottoms, and potential price targets. Bollinger Bands are a trend indicator that detects the volatility and dynamics of the price on the market. The bands contract when the price volatility is low and expand when the volatility increases. During the periods of low volatility, the bands are narrow, while during periods of high volatility, Bollinger Bands expand drastically. The upper band shows a level that is statistical high or expensive. The lower band shows a level that is statistical low or cheap. The Bollinger Bandwidth correlates to the volatility of the market. For a technical point of view, trading near the outer bands provides an element of confidence that there is a resistance at the upper boundary or support at the bottom boundary. However, this concept alone does not provide relevant buy or sell signals. All that determines is whether the prices are high or low on a relative basis. So the general consensus is that when the price reaches the upper band, it is considered as overbought, and when price approaches lower band, it is considered oversold. The Bollinger Bands have a default setting of 20 and 2. When using trading bands, it is the price action as it near the edges of the band that should be of particular interest to us. Now, regarding standard deviation of the Bollinger Bands, what is it? The standard deviation is basically a number expressing how much the value of price differs from the mean value. Prices will distribute around the simple moving average. Around 65% of price action is contained within a standard deviation of one of Bollinger Bands. Around 95% of price action is contained within standard deviation of 2 of the Bollinger Bands. Almost 99% of the price action is contained within the standard deviation of 3 of the Bollinger Bands. Okay, how to use this information? If you decide to backtest the Bollinger Bands and play with its input, you can adjust the value of standard deviation. If you lower it, you will see the price leaving the bands often, probably offering a lot of noise. However, if you increase it to 3, you will realize that the price will leave the band rarely, and might be better to find dynamic zones of support and resistance. So lower settings on Bollinger Bands will generate more trading signals, but will also increase the number of false signals, as the price movement will exit more often from the bands. On the other hand, a 2.5 standard deviation Bollinger Bands or even a 3 standard deviation will generate fewer but high probability signals. Now, I prefer to trade with the order in my favor. How to trade Bollinger Bands? The use of Bollinger Bands traders, depending on their overall trading strategy, style, and goals. When using Bollinger Bands, many define the lower and upper bands as price target. Some buy when the price touches the lower band and exit when the price touches the moving average in the center of the bands. Others prefer to sell when the price falls below the lower band and buy when the price breaks above the upper band. The upper and lower bands can act as dynamic resistance and support levels, as traders generally avoid buying when the asset price hit the upper Bollinger Band, respectively avoid selling when the price reaches the lower Bollinger Band. In a sideways market, when there isn't a clear trend on the chart, Bollinger Bands provide very good support and resistance, as most traders believe that there's a high chance of price staying within Bollinger Bands. Here, I use the Bollinger Bands with a standard deviation of 2.5 because the previous high and low point can just reach the upper and lower boundaries, which could perfectly verify the resistance and support effect of upper and lower boundaries. Of course, studies have shown that the penetration of Bollinger Bands with a standard deviation of 3 occurs rarely. The rest of the time prices fluctuate within the Bollinger Bands, and often price return to the middle of the bands. In this way, Bollinger Bands seem to act like rubber bands that can only stretch so far before snapping back to the middle. The upper and lower range of Bollinger Bands, which are created by 2 or 3 standard deviation lines, create the boundaries of price. Since there are greater odds that the price will be contained within the bands instead of penetrating them, one of the surest and the most common way of trading the bands is to buy when price near the low band and sell when price near the upper range band, but not blindly. We talked before about price action. This strategy is suited in non-trending market when there isn't a clear direction. Even more, when the bands are parallel, the signal is even more powerful. So we want to sell at the upper band and buy at the lower band when the bands are parallel, and preferably if we see additional confirmation of a support or resistance. Here are few examples of Bollinger Band signals during ranges. Also, you could take signals during trends, but only in direction of the main trend. Why is that? Just because price hit the upper or lower bands does not necessarily mean that it is a good time to sell or buy. Strong trends will read these bands and wipe out any traders attempting to buy on the low price in the downtrend or sell on the high price of an uptrend. In fact, price will be making new highs in the uptrend and new lows in the downtrend, hitting and exceeding the bands, quickly taking out the stop on the trades taken directly on the bands. So instead, we look to sell at the upper band during downtrends, meaning when the price is making lower lows and lower highs, and buy at the lower band in the uptrend when the price is making higher highs and higher lows. Practically, we look for pullbacks and corrections, but in the direction of the trend, we don't chase reversal. Here are a few examples of Bollinger Band signal during the trends. As we previously mentioned, Bollinger Bands Indicator measures the volatility on the market. The wider the band, the more volatility it has. A narrow band means indecision on price movement, and when this happens, it is almost always guaranteed that the market is about to move either up or down. Also, if the market has recently experienced a lot of volatility and the bands are far apart, this is a sign that the market will settle down and trade in a range in the near future. Another Bollinger Band strategy is relatively simple to implement, which is known as a squeeze strategy. Squeeze refers to a narrowing of trading range and implies a potential breakout. It happens when the price starts shifting sideways in a tight consolidation. You can visually identify when the price is consolidating as the lower and upper bands get closer together on the chart. It means the volatility of the particular asset has decreased. After a period of consolidation, the price usually tends to make a large move in either direction, ideally on higher value. Expanding volume on a breakout is a sign that traders are expecting that the price will continue to move in breakout direction. The longer it moves within this narrow band, the more likely the market is eventually going to penetrate these bands and continue on in the direction of breakout, especially if this event occurred in the direction of the previous established long-term trend. Timing is everything. However, just we don't know how long the squeeze will last. How to identify the breakout? Look at the hooks of Bollinger Bands. We want to see the upper band pointing up and the lower band pointing down. If the bands remain flat, or just the one band hooks while the other does not, the breakout isn't there yet. However, if upper band is rising while the lower band is falling, after a period of consolidation and tap range, this signifies that a potential explosion in price action is about to occur in the direction of the candlestick pushing against the band. The more vertical, the stronger potential move. Here are other examples of valid Bollinger Bands breakouts. If you think my video is helpful, subscribe my channel and hit the bell icon so you will be notified each time we upload. And leave us a like to show your support. I will see you next time. Bye!